Hi everyone, welcome to this month's financial market update and the last one for the June FY21 financial year. And it was a really solid end to the financial year as well. We saw both equity markets as well as bond markets rally, and the continued uplift that we've seen in commodities also continued over the course of June. We're looking at sort of our local market. It was up roughly around about 2.5% for the month. Global equity markets, depending upon $8 exposure, was up anywhere from 2.5% to 4.5%. REIT markets were certainly stronger. Certainly our local REIT market was up roughly around about 5.5%. Whilst the defensive part also rallied, with both domestic and global bond markets up roughly around about 0.5% to 1%. So we saw some really strong performance right across the board. Equally, commodities continued on their upward trajectory. The overall commodity market index was up over 2% for the month in June, predominantly driven by higher energy prices, whether through natural gas as well as oil prices, which were all substantially higher over the course of the month. The Aussie dollar, though, was the only negative. It was down roughly around about 3% in June, but continued a really strong financial year performance, which up over 8.5% against the US dollar, and also materially stronger against both the yen and the euro. Only weakness for the Australian dollar over the course of the last financial year was against the pound, and really that was on the back of improving and a reopening of the UK economy, certainly through the first half of this calendar year. But when we look at the performance of the major sectors over the last 12-month period, clearly equities and growth assets have been the real standout. Our local equity market was up roughly around about 28% over the course of the financial year, the best performing period since 1992. Equity markets, both domestic and global, were up over 30 to 40%, depending upon the market segment. Global small caps, for example, were up over 46% over the course of the year. Our local small caps were again up over 30%, and we saw, as I said, broad-based global equities up well over 30% over the last 12-month period. On the flip side, though, bond markets really struggled, and really that was on the back of higher bond yields, certainly coming through the second half of last year into the first part of this year. And we saw our domestic bond market down roughly around about 1% over the last 12-month period, whilst global bond markets were generally flat. 10-year yields up over 70 basis points here domestically, whilst in the US we saw global yields up over 80 basis points. And that really, as I said, caused the negative outcome that we saw in fixed income markets throughout the course of the last financial year. As we sit here today, we're seeing a little bit of a rally in fixed income markets, certainly as the outlook for inflationary expectations is somewhat moderated over the last little while. But nevertheless, as we think that recovery starts to take hold, as we look to see central banks around the world pull back on their bond purchase programs, and we certainly expect that to be the case through the back end of this year into FY 2022 and beyond. We think that will ultimately push yields higher over the journey. But the sell-off that we saw through the first part of this year, we think again was overblown. We've spoken about that previously, but notwithstanding that, we continue to expect that bond yields will move higher as a recovery, as I said, is underpinned and takes hold. Albeit inflationary expectations are somewhat moderated, we've seen a pullback in parts of the pricing market, whether it be in terms of housing or timber as an example on that side of things, as well as some commodities. And again, as that supply chain works its way through and the bottlenecks that we've seen, as that starts to become less prevalent, we think that will also see a moderation in prices. So even though we are expecting bond yields to move higher, we don't think we're going to again have that at a pace of what we've seen through the first part of this year. But notwithstanding that, from a positioning point of view, we continue to maintain an overweight exposure to growth assets, whether it be in equities or other growth alternative assets, at the expense of being underweight both cash as well as broader fixed income markets. The real standout, though, for the year was certainly in the commodity sphere. Broad-based commodity market was up over 45% for the year, and this was really led by really sort of key three types of commodities. Firstly, we saw iron ore up over 100% for the year and continues on a really strong rally that we've seen. Iron ore prices maintaining their over $200 a tonne on current levels. We saw copper and nickel, both industrial metals as well as those that are heavily used in renewable energy, again rallied significantly, up over 40% for the financial year. And then a big rebound in the energy spectrum, particularly natural gas as well as obviously oil, saw a big rally over the last 12-month period. Going forward, we continue to see those types of commodities maintain really strong performance in our view. Just again on the recovery theme, but equally, as I said, the demand for renewables is seeing a really strong push for commodities such as nickel, copper and lithium as an example, and we continue to believe that they'll be well supported going forward. From a strategy point of view, we haven't made any material changes to the portfolios over the month, and we'll continue to provide a bit more of an update on that when we provide our quarterly update directly on the portfolios. But the themes that we have in terms of being overweight growth assets, we certainly believe that the recovery cycle is well in train. Again, when we're looking at central bank commentary and the view that the tapering program is likely to kick into gear probably in the latter half of this calendar year, and we think that'll start with the reduction in the bond purchase programs as opposed to higher absolute levels of cash rates, but we think that may likely raise its head either at the latter stages of next year as it relates to the Fed and potentially into calendar year 2023 here domestically. So certainly the strength of the recovery may bring forward some of those rate hikes that central banks probably originally thought were going to be somewhere, as I said, latter stages of 23 into calendar year 24 here as an example. That may come forward a little bit, but the overall thematic we think remains very solid, and inflationary expectations, if they could be anchored at those lower levels, and we do believe, as I said, we're starting to see some pullback in parts of the market, and as supply chains start to work themselves through, we do think that ultimately that will see inflationary expectations come back somewhat, and it just means in terms of the recalibration around bond yields, we think that may be slower rather than quicker relative to what we've seen, and we think that that'll continue to provide a really nice environment for growth assets over the medium term. And as I said, that's how we're continuing to maintain that positioning across our portfolios. As always, if you have any concerns about the underlying strategies or any queries, please feel free to reach out to anyone in the team. And as I said, we look forward in catching up again next month. But it's been a terrific 12-month period for financial markets, and as I said, positioning hopefully will that continue going forward. Thanks, and bye for now.